Your pension is absolutely underperforming. Let's look at the reasons why in the stock market update for this week. Okay, it is Friday, the 5th of July when I'm doing this. And one of the most important things you can see is, yes, there are overvalued equities. And this is the bit most people don't quite understand. Certainly IFAs and fund managers don't understand that valuation is not the only thing that moves stocks, which is why the ones in red, which are the most overvalued, and you're paying $30 to buy a share of Apple for every $1 of profit it is expected to make. So you're paying 30 times each dollar of profit, whereas with ExxonMobil, you're only paying 11. Yet the ones in red are the ones which have done the best, is not because the market's irrational, it's not because it's stupid, it's because other factors such as growth are important. So when your IFA tries to sell you a value fund, ask them why they're ignoring growth and other factors, and that will explain also why you're underperforming. Now, let's have a look at the earnings calendar and what's coming up and that you should keep an eye out for, which might be important for the markets. JP Morgan's results, Wells Fargo, Citigroup will be the most important. To some extent, Pepsi will give some idea in terms of how the consumer is behaving. Nothing absolutely mega important, because that would really be the earnings from Meta, Microsoft, Apple, Amazon, and they're not due for the moment. Now, these are the various sectors. That's the 0% line I have just drawn here. And if you look at that, you can see which sectors you could almost pick blindly and have stocks winning in them. Well, to some extent, utilities. To a lesser extent, probably want to avoid real estate and basic materials. However, that's not how we pick stocks. Some old-fashioned people, actually energy, you could probably win in almost anything. That's not how we pick stocks, as that would be gambling. You'd be just hoping that the sector you go in does well. There's another problem. People say, oh, well, no, if I get the right sector, surely my stocks will do better. Well, isn't it better just to have stocks which will do better and not have to rely on the noise of the sector instead? So we take what's called a bottom-up approach, not top-down, but I think this is interesting to share with you. If you agree, let me know. Instead, what we want to do in our due diligence of picking stocks, and that's why we're far better than pension funds and fund managers, because tell me what I'm missing from this. Okay, we want the stocks to be undervalued, valuation. We want them to be growing in revenues and profits, at least for the past 1 year, if not longer, but 1 year is fine. We want dividend yields. Now, of that is twice as important as growth, which is twice as important as dividend yields. How do we know that? Well, if you look at the literature, and you can have a look at investing-champions.com for free. I've put a ton of literature on there on why I say that. See the books over my shoulder, the 18 Financial Times published books and Wiley published books. I put the research in there as well, but nobody reads books anymore. But if you look at investing-champions.com, all for free, you'll be able to download a copy of the books and also see the video and all the rest of it on there. Croakey comes from Goldman Sachs Wealth Management. Their research department, and they deal with the richest people in the world, discovered that companies generally, but not guaranteed, nothing's guaranteed in the markets, produce 30% per annum in returns as a basket if they're in the top quartile by cash return on capital invested. But it's only one factor you want to tick the box on. It's not the only one to use. There is no magic formula. It is due diligence. Now, why would undervalued, high-growing companies producing income and have a good cash return on their capital do well? Oh my God. Just listen to yourself. It's bloody obvious, isn't it? If you know anything about business. Momentum tends to persist. Don't take my word for it. AHL. John W. Henry owns Liverpool Football Club. That's because he has a momentum-based hedge fund. Momentum tends to persist. It's not guaranteed to. Those people who look for guarantees are idiots. There's no guarantees in the markets. What you're trying to do is remove all the stupid things you could do. And you remove those by making sure these first 5 boxes are ticked. Now, Sortino and Alpha, I completely cheat on to get good results. The Sortino means average returns and little risk of missing them. And Alpha is outperforms of the market, whether the market goes up or whether the market falls. So we just look for those and stocks exhibiting them. And we say, oh, right, we'll have those then. That's cheating because we didn't look at the fundamentals or the accounts or make up some narrative story. Didn't need to because we looked at the data. Data. not narratives and stories and smart-ass comments. Okay, past week, that's how it's gone. Look, all the expensive ones, Broadcom, Apple, Alphabet, Facebook. Well, Facebook fell a little bit this past week. Ooh, Tesla, we'll come to that later. Microsoft, Nvidia, we're going to come to all of these. The banks, they're undervalued and they're going up. That's good. That's good. But we'll have to see, will that continue? So we'll have a look at the specific charts in a second. Exchange traded funds. As many of you will know, I have a whole bunch of leverage ones, 2 times leverage, separate issue. Don't do leverage. Be careful. Okay. Year to date, NASDAQ's up 20%, but I want you to learn something. You'll get delight in the market, then you get despondent, then you get delight. For those people who think that 20% came from just going in a straight line, you're wrong. Why do private investors not have a 20% return in their pensions? The reason's very simple. Your IFA refuses to invest in American equities, or if they do, they put small amounts of money in because they get paid by a lot of different fund managers, and they will try and convince you that Microsoft is the most dangerous company on the bloody planet because your IFA is an idiot. Okay? Anyway, delight, despondent, delight. So what do private investors get wrong? Let's say they even got in here at the right time. They see it come back and then they get out here. So they see it go away and think, oh, I'll get out. And then they go, oh my God, I've got FOMO now. So they get back in over here. So out here, in here, they sell low and they buy high. That's what they do. It's human nature, right? So how do we know to remain calm during this period? Very simple. That was a mama bear, which I'll come to later. So it could be ignored. Now, we also don't, and these are all there's a lot of landmines with investing. Here's another little landmine with investing. We don't gamble on the horse race that is energy, communications, financials, and all of this. And why? Sorry, technology, communications, financials, energy, utilities. We don't gamble on which horse is going to be in the lead. What we'd look for are companies which exhibit growth and value and momentum, actually all of these factors, so that whatever happens, ours should have been in this group. They would be in this group because they tick all the boxes of due diligence. Okay, over the past year, ask your IFA, why isn't your portfolio up 33%? Or the S&P, 24%. Okay, again, look, delight, despondent, delight, despondent, delight. So your trick is how to stay calm during those periods, and also how to stay calm when you've got a 0% return for 6 months. 6 months of no return, months of no return, and yet 32% up. Because if you don't understand how prices tend to move and how you can ignore a baby bear and a mama bear market, i.e. small falls, then of course you're going to panic. So how do we avoid panic? Well, first of all, we're going to remember the D's. Delight, despondent, delight. We know to take care of that. And also, when I show you the charts in a second, what we're going to do is we're going to look at drawdown depth and duration. How long do those drawdowns last and how deep are they? If we don't like them, we stay away from those stocks to begin with, and it makes our job a hell of a lot easier. We do the Warren Buffett approach. We put all our eggs in one basket, watch the basket. In other words, we concentrate on the best companies so we can remove all the rubbish, so we're not speculating. And secondly, if we're not happy with the company, we don't buy it. We just don't have it. We hold cash instead. So that's the FTSE 350 over the past month. S&P I'm going to cover in part 2 alongside a whole bunch of stocks in part 2. So watch that. Part 2 coming up in a second on a separate video. Thank you very much.